Meet Mia. She's 26, works as a dental assistant in Phoenix, and makes decent money, about $42,000 a year. But when she tried to rent her own apartment last year, she got rejected. Not because of her income, because of her credit score. It was 520. Lenders saw her as high risk. She was paying higher rates on everything, and she had no idea why. In the next 10 minutes, we're going to break down exactly how credit scores work, what was wrecking Mia's score, and the step-by-step plan she used to climb from 520 to over 720 in just 18 months.
So, what exactly is a credit score? It's a 3-digit number ranging from 300 to 850. Lenders use it to decide whether to give you a loan and at what interest rate. The higher the score, the less risky you look, and the better the terms you get. The most widely used model is the FICO score, developed by Fair Isaac Corporation. When Mia got rejected from that apartment, the landlord pulled her FICO score and saw 520, which falls in the poor range. Anything below 580 is considered poor credit. Between 670 and 739 is good. Above 800 is exceptional. Mia's goal? Get to at least 700, so she could qualify for better rates and housing.
Here's what actually determines your score, and this is where Mia had her aha moment. Your FICO score is built from 5 factors. Payment history is the biggest. It's 35% of your score. That means paying on time is the single most powerful thing you can do. Next is credit utilization, which is 30%. That's how much of your available credit you're actually using. Then there's length of credit history at 15%, credit mix at 10%, and new credit inquiries at the last 10%. When Mia looked at her credit report, 2 things stood out immediately. She had 2 missed payments from 2022, and she was using over 80% of her credit card limits. Those 2 issues alone were responsible for most of her low score.
Let's look at how your credit score actually affects your wallet. This chart shows the average interest rate you'd pay on a 30-year mortgage based on your credit score range, according to data from MyFICO. Look at the gap between a poor score and an exceptional score. Someone with a 620 score might pay around 7.5% on a mortgage. Someone with a 760 or above might get 6.1%. On a $300,000 home loan, that difference adds up to over $100,000 in extra interest over the life of the loan. This is why Mia's mission to fix her credit wasn't just about renting an apartment, it was about her entire financial future.
Here's the number that finally made it real for Mia. $103,000. That's the estimated extra amount someone with a 620 credit score pays versus someone with a 760 score on a standard 30-year, $300,000 mortgage. That's not a small difference. That's a car, a college fund, or years of retirement savings. And mortgages aren't the only place bad credit costs you. Auto loans, personal loans, credit cards, even insurance premiums, they're all affected. Your credit score is one of the most financially impactful numbers in your life. The good news? You have more control over it than you think. Now let's get into what Mia actually did, starting with payment history, the biggest factor at 35%. The first thing she did was set up auto-pay for every single bill. Credit cards, student loans, her phone bill, everything on auto-pay for at least the minimum payment. This guaranteed she'd never miss another due date. Then she called her credit card company about the 2 late payments from 2022. For longtime customers, some lenders will offer a goodwill adjustment, essentially removing a late payment from your record if you ask nicely and have a solid history otherwise. One of Mia's lenders agreed. Within 60 days of consistent on-time payments, she saw her score tick up by 18 points just from this step alone.
Remember how Mia was using 80% of her available credit? That was crushing her score. Credit utilization, how much of your limit you're using, makes up 30% of your FICO score. Most experts recommend staying below 30%. Getting under 10% can push your score significantly higher. Mia had 2 credit cards with a combined limit of $3,000 and balances totaling $2,400. Her plan: pay down $1,500 over 4 months using her tax refund and extra income. She also called her card issuer and requested a credit limit increase, which, if approved without a hard inquiry, instantly lowers your utilization percentage. Within 6 months, her utilization dropped from 80% to 22%. Her score jumped another 40 points.
This is the chart that shows Mia's actual progress, a realistic credit score recovery timeline over 18 months. Notice it's not a straight line. That's normal. Some months it dipped slightly when she applied for a new card, but the overall trend was consistently upward. Month 1, she started at 520. By month 6, she had crossed 600 after addressing her payment history and starting to pay down balances. By month 12, she was at 660, officially in the fair range and able to qualify for her apartment. And by month 18, she crossed 720. That's the power of consistent, informed action over time. No magic fixes, just the right habits repeated.
Beyond fixing mistakes, Mia also took steps to actively build positive credit history. One of the smartest moves? Her mom added her as an authorized user on a credit card she'd had for 12 years with a perfect payment history. That account's age and clean record showed up on Mia's credit report, instantly boosting her average account age and her score. She also pulled her free credit reports from annualcreditreport.com, the only federally authorized free report site, and disputed 2 errors she found. One was a collection account that wasn't even hers. Disputing errors is free, and the credit bureaus are legally required to investigate within 30 days under the Fair Credit Reporting Act.
Let's talk about what Mia almost did wrong, because these mistakes are everywhere. First, she nearly closed her oldest credit card to simplify her finances. Don't do this. Closing a card reduces your available credit and shortens your credit history. Both hurt your score. Second, avoid applying for multiple new cards in a short window. Each application triggers a hard inquiry, which temporarily lowers your score. Third, and this one surprises people, paying off an old collection account doesn't automatically remove it from your report. It still shows as paid collection for up to 7 years. Finally, be cautious of credit repair companies charging hundreds of dollars for things you can do yourself for free. The tools exist, you just need to use them.
Today, Mia has a 722 credit score. She got approved for her apartment, refinanced her car at a much lower rate, and is now saving up for a home down payment. She didn't use a credit repair service. She didn't find any shortcuts. She just understood the 5 factors, fixed what was broken, and stayed consistent for 18 months. Here are your 5 key takeaways. Pay on time, every time. Set up autopay right now. Keep your credit utilization below 30%. Pull your free credit report and dispute any errors you find. Don't close old accounts. And finally, be patient. Credit repair is a marathon, not a sprint, but the financial rewards are absolutely worth it. This video is for educational purposes only. Always consider consulting a financial advisor for your specific situation.
Everything in this video is for educational purposes only and does not constitute financial advice. Credit improvement results vary based on individual circumstances. Always consult a licensed financial professional before making major